Welcome to Tax Takes. My name is Gay Proberts Camp. In this video, we will review the income tax rules applicable to the entry and exit of an entity from a tax consolidated group. As you watch this video, I recommend that you have your learning materials open so that you can highlight key sections and add your own notes. As you should know, the key consequence of forming a tax consolidated group is that the group is treated as a single entity for income tax purposes. The four key effects of the single entity rule as outlined in Taxation Ruling 2004/11 are: assets of the subsidiary members are deemed to be owned by the head company, intragroup assets and liabilities are not recognised, intragroup transactions are not recognised, including intragroup dividends, and actions of subsidiary companies are treated as having been undertaken by the head company. Broadly, this is similar to what happens for accounting purposes when a company is consolidated with another entity. But for those who have completed the FIN module of the CA program, there are no ownership percentages for tax consolidation purposes. An entity is not in the tax consolidated group if it is not 100% owned. Some additional aspects of working as a single entity are: a single franking account is maintained by the head company. So even though under the corporations law, a subsidiary company will continue to distribute its profits to the holding company via the payment of dividends, those dividends have no franking implications, or in other words, they cannot be franked and do not get included in a franking account. Unutilized income and capital losses can be transferred to the head company when the group is formed. The utilization of these losses by the head company is limited by the application of an available fraction. The entry history rule treats everything that happened in relation to an entity before it became a subsidiary member as if it happened in relation to the head company. The eligibility requirements for a consolidated group are: the head company must be an Australian resident and the top entity in the structure. The head company can also be another type of entity where that entity is taxed at the company tax rate. A subsidiary member must be a wholly owned company, trust or partnership of the head entity, except for shares acquired under an employee share acquisition scheme where the total of those shares do not exceed 1% of the number of ordinary shares in the company. Interposed entities must be a member of the tax consolidated group and be an Australian resident, but cannot be prescribed dual residence. And finally, both the head and the subsidiary members must have at least some of their taxable income, if any, taxed at the general corporate tax rate. A tax cost setting process is applied at the time the joining entity becomes a member of the tax consolidated group. Under the single entity rule, the assets of the joining company become those of the head company. All the cost bases are reset so that the price paid for acquiring the membership interests in the entity is pushed down to those individual assets. There are three stages to the tax cost setting process under Section 705-35. The acronym often used for this three-stage process is TCSA. The first stage is the 8 steps required to calculate the entry allocable cost amount, or ACA. The equation underlying the ACA steps is broadly based on restating the assets less liabilities equals equity formula used to compile a balance sheet. That is, assets are equal to equity plus liabilities. The second stage requires the joining entity's assets to be classified, and the third stage allocates the ACA from stage 1 to the assets identified in stage 2. The second stage of the process requires assets to be classified as either retained or reset assets. However, before considering these definitions and how they apply to the tax cost setting process, it is important to determine what is an asset for tax consolidation purposes. Assets for tax consolidation purposes are defined in Section 107-67 as CGT assets, revenue assets, depreciating assets, trading stock, and a thing that is or is part of a Division 230 financial arrangement. Generally, the tax cost setting rules will not result in tax costs being allocated to assets that are not ordinarily recognised for tax purposes. For example, customer-related intangibles, that is customer list, and technology-related intangibles, that is information databases, processes, and trade secrets. The meaning of CGT assets, depreciating assets, and trading stocks is covered in earlier units of your learning materials. A revenue asset is an asset which, on disposal, would give rise to an assessable or deductible amount under Section 65 or 81. For example, an investment bought for a profit-making purpose of a company. Division 230 applies to financial arrangements and is considered in Unit 13 of your learning materials. Essentially, this would include intangible assets or rights that are related to carrying out financial transactions. For example, shares, swaps, and options. So let's check your understanding. Which of the assets listed on this slide would be an asset for tax consolidation purposes? The correct answer is the goodwill, work in progress, and prepayments. A deferred tax asset is not a tax consolidation asset. It is a balance arising in the balance sheet due to tax effect accounting and is not an actual asset for income tax or tax consolidation purposes. An unregistered trademark is not a tax consolidation asset. It is a marketing related intangible asset that would not be considered to be an asset for income tax or tax consolidation purposes. Intangibles that are not recognised separately for taxation purposes are commonly included in the value of goodwill for taxation purposes. So now let's look at a retained and reset cost base asset. The tax cost of a retained cost base asset is generally set at the amount that is equal to the joining entity's cost of the asset. A retained cost base asset under Section 705-25 includes Australian currency, debts, units in certain managed unit investment trusts, prepayments, and a right to future income other than work in progress amounts. A reset cost base asset under Section 705-35 is any asset of the joining entity that is not a retained cost base asset. For example, trading stock, work in progress amount assets, revenue assets, depreciating assets, and CGT assets. So let's check your understanding. Do you think goodwill is a retained or a reset cost base asset? The correct answer is that goodwill is a CGT asset and therefore is a reset cost base asset. At stage 3 of the tax cost setting process, once the ACA has been calculated and the assets have been categorised, the tax cost setting amount is first allocated to retained cost base assets. The remainder is allocated to reset cost base assets in proportion to their market values. A cap applies under Section 705-40 to restrict the amount that can be allocated to assets on revenue account. For example, trading stock and other revenue assets, and depreciating assets. The cap is equal to the greater of the asset's market value or the terminating value. To the extent the amount of ACA allocated to a particular asset is reduced by the capping rules, the reduction amount is reallocated to other reset cost-based assets in proportion to their market values, provided those assets do not breach Section 705-40, if applicable. So let's work through an example together. On the first day of the current income year, Company A purchased 100% of the shares in Winebook and formed a tax consolidated group. Both companies are Australian residents. Company A paid $750,000 for Winebook, and its allocable cost amount was correctly calculated to be $950,000. Winebook's balance sheet at the time of acquisition and the tax cost setting amount allocated to each asset are outlined on the next two slides. You are required to explain the taxation consequences for Company A as a result of the formation of the tax consolidated group. For the purposes of this example, we will not be working through the details of stage 1 of the tax cost setting process, being the 8 steps of Section 705-60 to calculate the ACA. The background facts tell us that the ACA is $950,000. In an exam where a background fact or an assumption is provided, you should use this in answering the required task. No marks will be allocated to reperforming or verifying a calculation. Winebook's balance sheet as at the time of acquisition is provided on this slide. The first thing you need to do to complete the required task for this question is to consider the assets Company A has acquired for tax consolidation purposes. Given this balance sheet and the amount Company A paid for the acquisition, do you think Company A has acquired any goodwill as part of this acquisition? The correct answer is yes. This is not purely a tax question, it is a basic business acquisition accounting question. At the time of the acquisition, Winebook's net asset value was $200,000. That is $400,000 in assets less $200,000 in liabilities. Therefore, the $750,000 paid by Company A to acquire the shares in Winebook was made up of the value of the net assets in the financial statements of $200,000, the unrecognised increase in the market value of the building of $50,000, and an unrecognised goodwill balance of $500,000. The unrecognised goodwill and the additional market value of the building must be taken into account in allocating the tax cost setting amount to the assets. The second and third stage of the tax cost setting process for Winebook is also provided as part of the scenario. So let's go through it together. The second stage of the tax cost setting process is to classify the assets as either retained or reset cost base assets. As per Section 705-25, cash and prepayments are retained cost base assets. Therefore, the amount allocated to these assets will be equal to the value of the assets in Winebook's financial statements. But buildings, trading stock, and the unrecognised goodwill are reset cost base assets. A market value cap will apply to the trading stock under Section 705-40. However, buildings and goodwill are not revenue assets. Therefore, the market value cap does not apply to these assets for the purpose of allocating the tax cost setting amount. The third stage of the tax cost setting process is to allocate the ACA totaling $950,000. Firstly, against the retained cost-based assets of cash and prepayments totaling $100,000, which is equal to their cost in Winebook's financial statements. The balance of the ACA of $850,000 is then allocated against the reset cost-based assets in proportion to their market values. In this example, the market value of trading stock is $50,000, buildings $300,000, and goodwill $500,000. Therefore, the balance of the ACA is allocated to each reset cost-based asset by dividing the market value of the asset by the total market value of all the reset cost-based assets. This results in a final allocation of ACA to trading stock of $50,000, buildings of $300,000, and goodwill of $500,000. The cap under Section 705-40 for revenue assets has no impact in this question because the allocation of the ACA to the trading stock does not exceed its market value. So now that we've reviewed all the facts, what are the consequences for Company A on forming its tax consolidated group? So let's review the solution. Looking at the tax cost setting amount calculations, there is no excess of ACA that cannot be allocated, and the ACA is not a negative amount. Therefore, there are no immediate CGT consequences for Company A on forming its tax consolidated group. This is a very simple scenario. In practice, the formation of a tax consolidated group or the entry of another member to an existing tax consolidated group will often have immediate tax implications for the head company. In this example, Company A also now has a series of new assets that it must take into account in its future income tax calculations. Where the prepayment does not relate to excluded expenditure under Section 82 KZL, that would have been claimed as a tax deduction by the subsidiary just before it joined the tax consolidated group, Company A will be able to claim a deduction for the amount allocated to the prepayment of $10,000. Company A also has trading stock with a tax cost now of $50,000 that must be taken into account when determining the assessable or deductible amount under Division 70. And Company A now has a building with a cost base for CGT purposes of $300,000. Company A would use this value to determine any capital gain or loss when the building is sold. In this example, there are no depreciating assets, but if there were, Company A would use those values allocated to depreciating assets to determine its future decline in value deductions. There are no franking account details or carry forward loss details provided in this question, so there is no impact for Company A in respect of these. So let's do a what if extension question to check your understanding of the tax cost setting process on entry to a tax consolidated group. From the facts, you know that Winebook has $100,000 allocated to its retained cost-based assets, which leaves $850,000 in ACA to be allocated to its reset cost-based assets. But what if Winebook had no reset cost-based assets? What would happen to the excess ACA? The correct answer is that CGT event L4 applies, and the excess would be treated as a capital loss for Company A. If the situation was the other way around, that is, the value of the retained cost-based assets exceeded the ACA, then CGT event L3 applies, and the shortfall would be treated as a capital gain under Section 104-510. Okay, let's do a different change of facts. This time, what if the ACA allocated to Winebook's trading stock was $80,000? That is more than its market value of $50,000. What had happened to the excess? The correct answer is that a cap applies to the amount of ACA that can be allocated to revenue assets like trading stock. Therefore, the excess $30,000 would need to be reallocated to other reset cost-based assets that are not subject to capping. This reallocation is done in proportion to their market values. Now, what if the ACA allocated to Winebook's building was $400,000? That is more than its market value of $300,000. What would happen to this excess? The correct answer is that nothing would happen. The ACA for buildings is not subject to capping. So now let's consider the process that takes place upon exit of a subsidiary member from a tax consolidated group. As you should know, the exit history rule operates to transfer the income tax history back to the subsidiary in relation to eligible assets. Eligible assets are defined to include any asset, liability, and business. This would include, for example, an undeducted inherited deduction, such as a borrowing cost prepayment or employee provision. For depreciating assets, this would include the acquisition date and the termination value. On exit of a subsidiary member from a consolidated group, The head company must establish a tax cost in respect of the membership interests in the subsidiary, that is, its shares, for the purpose of calculating a capital gain or loss on the disposal. A key point to remember in respect of an entity that leaves the tax consolidated group is that it does not get any of the franking credits or carry forward losses from the consolidated group. This is the case even where it is the assets that the leaving entity is taking with it that generated the franking credits or the carry forward loss, and even where there continue to be losses or franking credits in the head company that were transferred to the head company when the leaving entity joined the tax consolidated group. Just like on entry to a tax consolidated group, there are broadly three stages or steps that need to be completed when an entity leaves a tax consolidated group. The first stage is to calculate the exit ACA of the leaving entity. The purpose of the exit ACA is to align the cost of the membership interests with the net cost of the assets that the leaving entity is taking with it. As a consequence, it does not matter whether the head company disposes of those assets or the shares in the leaving entity for income tax purposes. There are 5 steps in the exit ACA calculation. Where the amount after step 4 is negative, the exit ACA is deemed to be nil, and the negative amount is treated as a capital gain under CGT event L5. However, where the ACA amount is positive, then under stage 2, the ACA amount is divided by the membership interests, that is, the shares on issue, to determine the cost base per share. The final stage of the ACA exit process is to calculate the actual capital gain or loss on disposal of the membership interests. This is a normal calculation for CGT event A1 that was covered in Unit 4 of your learning materials. So let's consider an example that illustrates how CGT event L5 arises in relation to the exit ACA. In this example, WineRack Proprietary Limited is a member of the Company B Tax Consolidated Group. On the last day of the income year, Company B disposed of its ordinary shares in WineRack for $300,000. WineRack has cash of $20,000 and a building valued at a market value of $100,000. The terminating value of the building or the original cost is $60,000. It also has liabilities totaling $100,000. WineRack therefore has an exit ACA amount of nil. That is, applying the 5-step process. Step 1, start with the terminating value of the assets, being the cash and the building, which equals $80,000. Step 2 and 3 are not relevant for this example. Step 4, subtract the liabilities of $100,000. This gives a negative amount of $20,000. Therefore, the ACA under Step 5 is taken to be nil. In this example, you are required to calculate Company B's capital gain, to identify the relevant CGT events that have occurred, and to show all workings. The disposal of the shares gives rise to CGT event A1. In calculating the capital gain or loss on disposal for this event, the capital proceeds are $300,000. The cost base of the shares is determined by applying the 5-step exit ACA calculation in section 711-20. However, as the outcome of these steps is a negative amount, the cost base is taken to be nil. Or in other words, the ACA process does not attribute a positive amount or cost base to the shares that Company B has disposed of in WineRack. In addition to the CGT event A1 capital gain, there is also a deemed capital gain under CGT event L5 of $20,000, namely the negative amount after step 4 of the exit ACA process. Therefore, Company B's total capital gain for the current income year is $320,000. That is $300,000 capital gain under CGT event A1 and $20,000 under CGT event L5. Before we finish up, let's check your understanding of the link between tax consolidations and franking account. Would a dividend received by Company B from WineRack prior to its leaving the tax consolidated group have an impact on Company B's franking account? The correct answer is no. While WineRack is a member of the tax consolidated group, intragroup transactions, including dividends, are ignored for income tax purposes. So now let's do some what-if questions to check your understanding of the tax cost setting process on exit. What if WineRack's liabilities were only $50,000 and therefore the exit ACA amount was a positive amount of $30,000? That is, $80,000 less $50,000 is $30,000. We know from the facts of the scenario that Company B sells its shares in WineRack for $300,000. So using both of these facts, what is Company B's capital gain? The correct answer is $270,000. That is $300,000 proceeds on disposal less $30,000 cost base of the shares. The purpose of the exit ACA calculation is to determine the cost base of the shares held by Company B in WineRack. If the exit ACA amount is positive, then there are no additional CGT events that need to be considered. The only CGT event is CGT event A1 for the disposal of the shares. So let's change the facts in a different way. This time, what if the required task was to calculate Company B's net capital gain? What else would you need to consider in answering this exam-style question? The correct answer is you need to consider the application of the SBE CGT concessions. We know from the facts that Company B is a small business entity. Therefore, you need to determine if Company B satisfies the basic eligibility conditions, and if so, the specific eligibility conditions for particular concessions. So good luck with your studies, and I look forward to chatting with you again soon.